Relating to value investing, I don't know that it ever comes back. You know, there have been serious changes to the market structure, and pretty much most of the value investors have been put out of business. So if value investing is trying to do security analysis, think about what companies are worth, think about why they might be misvalued or misunderstood, and then do valuation analysis that tells you that that in fact is true, there's just very few of us left. Most market participants these days, they either cannot do value, they're just not trained or experienced in knowing how to do valuations.
The worst decade now for value investors in history, worse than the dot-com bubble, and it's time for a rethink.
Nowadays, the structure of the markets and where everything is priced and done the normal way will give you probably a return in the vicinity, with a lot of risk around it, maybe in the vicinity of 4%, 3%, 4%. Okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it.
I would argue that there's going to be plenty of opportunities, and part of the reason there are going to be plenty of opportunities, the tech doesn't make any difference or any of that. I mean, if you look at how the world's changed in the years since 1942 when I started, you'd say, well, how does a kid that doesn't know anything about airplanes, that doesn't know anything about engines and cars, and doesn't know anything about electricity and all that? But that really isn't the world changing doesn't, or new things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. Well, the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things, and the reason they do it to some extent is because they can get money from other people so much easier than when we started. So you could start 10 or 15 dumb insurance companies in the last 10 years, and you could become rich if you were adroit at it, whether the business succeeded or not, and the underwriters got paid, and the lawyers got paid. And that creates, if that's done on a large scale, which it couldn't be done 58 years ago, you couldn't get the money to do some of the dumb things that we wanted to do, fortunately. And so I think that investing has disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas that isn't outperforming. And I think if you don't run too much money, which we do, but if you're running small amounts of money, I think the opportunities will be greater.
Intelligent investing is value investing. So people have this misnomer that there's growth investing and value investing, and they're two separate things. It's two sides of the same coin. So what we're trying to do with investing is we're trying to put out $1 today with the hope that we get more than $1 in the future back. And how long it takes to get $2 back or $3 back and such will determine our rate of return. Definitely you're going to do, in general, better if you invest in businesses which have strong growth prospects, as long as you're not paying too much for that growth. So it took me a long time to get there, but if you buy a dollar bill for 25 cents and it's not going to change much in value, and you're correct about that it's worth $1, you'll make 4 times your money. And depending on how long it takes to make 4 times your money is whatever your annualized rate of return is. But if you are able to invest in a Starbucks relatively early, they could have almost an infinite number of stores globally. And the unit economics are so good. In the US, when they open a Starbucks, in 18 to 24 months, they get all their money back that they put into a store. And internationally, they get it in 12 to 15 months. It's an incredible business. I mean, your ROEs are off the chart. This is unlevered returns of like 60, 70% unlevered. And with an ability to create an infinite number of coffee shops. I mean, in Manhattan, they would put 4 coffee shops on 4 corners, and none of the businesses went down. They all did well. So the holy grail is to find the great compounders, where the dollar becomes much more valuable. You don't necessarily need to even pay much less than $1. As long as you're right on the growth prospects and you can run that, then that can work out quite well. So value investing is not dead because investing is not dead. And anything that is not intelligent in terms of investing is not value investing. That all falls into the category of speculation.
You have to know something others don't know. You have to either have facts they don't have, and the SEC has the goal of making sure everybody has all the same facts, or you have to have a superior ability to interpret that. But chances are you're not the only smart person who's trying, so it's not even clear you can get an edge that way. So Andrew says you can't base investment success on currently available quantitative information. It has to be, your superiority has to come through either a better understanding of the qualitative information, which by definition, in my opinion, by definition can't be the result of an algorithm, or superior insight with regard to the future. And that's what the memo is mostly about. And there's a great quote from Buffett. He says, we are not growth investors or value investors, we're investors. And so the trouble is when things get labeled, then they get narrowly defined. You have to, I think, to be an investor in the coming decades, you have to be broad-minded, and you have to say, I'll buy anything at an attractive price.